The hearing in the Committee on Financial Services will come to order. This is a very important topic. It is one that is clearly very much affected by actions this committee has taken, and it's a matter of great interest to many members of the committee. It is also directly relevant to pending legislation, because the issue of what the loan limits should be going forward for Fannie Mae, Freddie Mac, and the FHA is going to be decided in the next few weeks. The Senate committee has passed a bill that raises the limit somewhat. We have one that has raised them higher. We have the stimulus package, which has raised them until December 31st. As I look at the two bills, and I am very encouraged that the bill that passed 19-2 out of the Senate committee and the bill that passed this House are really very close conceptually. I am confident we're going to be able to resolve the differences, but this is one of the differences that will have to be resolved. So today's testimony is important both in terms of the current situation, but also could have an impact on what we do going forward. I will say that I was disappointed when the loan limit increase produced less activity than I had hoped it would. I understand there are reasons, and I also believe that we're going to come out of this today with a strong argument against the yo-yo effect, and in fact a strong argument for leaving them where they are. I did notice, for instance, that when we were debating this in the FHA modernization bill, when that became the one issue that prevented us from doing the FHA modernization, both the Secretaries of Treasury and HUD, then still Secretary Jackson, agreed with us that it would be a mistake to drop the limits. In terms of just economic theory, the most variant price in America, I believe, is the house price. The immobility of housing means that you get greater geographic variance in that price than in almost anything else. And having one set price couldn't have made sense. It had to be either too high or too low. There just was no way, given the variations. What we've seen, I think, recently is a problem in the private market, and I think there has been a consensus that's been shared by many here, by the head of the Federal Reserve, who's been very active in this, by the Secretary of the Treasury, that this is a time when public and quasi-public entities can work cooperatively with the market in unsticking things. But we have a problem now, and we had this problem in the loans above the limits, that they weren't selling. We tell the story about the child who touches the stove and gets burned and then doesn't touch the stove again. Well, we have had a situation in the credit markets where a number of very smart people bought things they shouldn't have bought. Having bought things they shouldn't have bought, they now refuse to buy things they should buy. And we had this with 100% guaranteed student loans, and I think you have to update, unfortunately, the story of the little boy. The little boy touched the stove and got burned, and now won't touch the stove, or the refrigerator, or the bathtub, or the sink, or the toilet. And what we need to do is cooperatively work with people to get them back to touching white porcelain, just being a little more differentiating into which ones they touch. I think that public-private cooperation plays a large role here. Ultimately, to the extent that we get out of the current situation and we get back to where the private market does this without as much involvement from the others, fine, although we should be clear that neither the FHA nor Fannie and Freddie displace the private market, but in fact work with it, multiply it, in Fannie and Freddie's case by securitizing, although that's a particular issue that I would have now that I'm going to ask people to address in the question period. It may not have been in the initial issue we'll be talking about, because we now have in the Senate bill a provision that says even to the extent that they raise the loan limits, not enough in my judgment, those loans have to be securitized. And I think that would just add to the current complication. I think there should be the option of securitizing, but not the mandate. We actually specifically addressed that issue in the stimulus and explicitly decided, and I had a conversation with Secretary Paulson about it, not to require securitization, because I think that that even makes securitization harder. I think securitization will work better if it can be left to be done when it makes sense and not be mandated, but that's something that we will want to address with people. So I think we've got a clear economic case now for raising the limits, but we still have to get till a later point. Maybe we'll have resolved this. I do believe the bill will be signed by July 4th. I'm now convinced that I think we will now get a bill signed that's very close to what we've been doing, and I'm going to make another bold prediction that we will not only get a bill signed, but we will get the whole bill signed. I think we'll get a bill signed that has every title and every section. We have adopted a new procedure you may have noticed with the agriculture bill. It's called the reverse line item veto, in which we delete items before they get to the president. But there's a great consensus on making this work. I know I'm joined by my colleague from California, Mr. Miller, and others who care a lot about this. So with that, I'm going to call now on my Republican colleague for an opening statement, and we have only one panel. This is a very important issue to people, and I think this is going to be a very substantive hearing. Mr. Backus.